My view is that the world has been in a depression since 2007 and will remain so for an indefinite period of time. And when you say that, people are, wait a second. We know the definition of a recession. The technical definition of a recession is 2 consecutive quarters of declining GDP, rising unemployment. There's a few other bells and whistles. There's a little bit of subjectivity to it. The National Bureau of Economic Research are the unofficial but widely followed referees on when you're in a recession and when you're not. Well, we're in the expansion. The expansion started in June 2009. So wait a second, how can we be in a depression if we're in the 10th year of an expansion? And the answer is that people don't really understand the definition of a depression. They assume intuitively, well, if a recession is 2 quarters of declining GDP, and a depression sounds worse, it must be 6 quarters of declining GDP. Well, we haven't had that. But that's not the definition of a depression. The definition of a depression is a sustained period of below trend growth, with no particular tendency to collapse or getting back to trend. In other words, I'll use the United States, but you can apply this more broadly to the world. If trend growth is 3.5%, and that's probably the long-term potential of the United States, you can higher nominal growth with inflation, but we're talking about real growth. If trend is 3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth. You're not in a technical recession, but you're in a depression because you're not getting back to that trend. And people say, well, 2%, 3%, it's 1 percentage point. Who cares? No, that gap is huge. And because of the compounding effect, think of it as a wedge. There's the trend line. Here's the actual line. That wedge gets bigger. So we're 10 years out. We've left $5 trillion of potential growth on the table. That's the output gap or the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. But being objective, using the numbers I mentioned, we're in a depression. We're going to stay that way. The United States is Japan. Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their 3rd lost decade. If something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, oh, well, the headwinds, demographic, technological, productivity, psychological, et cetera, haven't changed, and there's no reason to expect they'll change. So combine this world depression, because what I just described is true of Japan, it's true in Europe. Not so true in China, but China's a special case. There's they cook the books. They're 7, 8% growth that they've been printing. Cut that in half because 45% of that growth is infrastructure, most of which is wasted. So if you apply generally accepted accounting principles and made them write off all that wasted investment, they'd be a lot lower than it appears. But the whole world is caught in this trap. Meanwhile, debt is going up faster than the growth. Is debt good or bad? Well, it depends. Debt can be good if you can afford it, if you can pay it off, and you can use it for productive purposes. It's bad if you can't afford it, it's not sustainable, you're using it as a substitute for real growth, and it's all going to crash and burn. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is getting worse. It looks like we're heading for a global debt crisis. Not quite there yet, but it could happen sooner than later. Very little doubt that the Fed is going to tighten in September. My baseline scenario for the Fed is straightforward. They're going to tighten 4 times a year, every March, June, September, and December, 25 basis points each time until they get interest rates up to, 3.25%, 3.5%, somewhere in that range, unless one of 3 pause factors applies. The pause factors are disorderly decline in stock markets, employment starts to go down, they basically lose jobs, their unemployment's going up. The third one, disinflation or deflation spins out of control. Right now, none of those 3 pause factors applies. The stock markets, they're going sideways, but they're not crashing. The Fed doesn't care if the stock market goes down 15% in 6 months. They do care if it goes down 15% in 6 days. That's disorderly, and that's the kind of thing where you would see the Fed pause, but that's not happening right